Okay, so unearned revenues. So unearned revenues are amounts of money that we have received before we've given the goods to the customer or before we have provided the services. So when we get the cash, we debit unearned, we debit cash. When we get the cash, we debit cash and we credit unearned revenue. So it'll either be unearned service revenue or unearned sales revenue. If it's a service, it would be unearned service revenue. If it's a product we sold, it would be unearned sales revenue. So when we earn the money, so when we actually provide the service or provide the product, then we have to do an adjusting entry in order to recognize how much we've earned. So when we do the entry to recognize, we're going to debit the unearned revenue account, which will make that number go down. And then we're going to credit the actual revenue account, which will make that number go up. So we move the money over from being unearned to being actually earned. And we see this in places like airlines or magazine publishers or hotels, or another big one is sporting events where people buy season tickets and they pay for tickets ahead of time, and then the tickets, they don't recognize the actual earning of the tickets until the game is played, because if they never play the game, then they have to give that money back to the people that paid for the tickets. So let's go to the next slide here. Here's an example. Superior University sells 10,000 season football tickets, all for $50 each for its five-game home schedule. The entry for the sales of the season tickets is, and so it's 10,000 times $50, so that's $500,000. They're going to debit cash, $500,000, and they're going to credit unearned ticket revenue, $500,000. Okay, so that's to recognize the ticket revenue that they haven't earned yet, but they received the cash. Then it says, as each game is completed, Superior records the earning of revenue. So on September 7th, they play one game. So it is 500,000 divided by 5 is $100,000 per game. So they are going to debit unearned ticket revenue to remove the $100,000 from there. And they're going to credit ticket revenue, $100,000, to recognize the earning of that $100,000 for the game that they played. So I'm going to stop that there. The current maturities of unearned debt is not something that you're going to have to deal with in here. But basically what this is talking about is if you look at a financial statement for a company and you're looking at their liabilities, you're going to see like the mortgage liability is under the long-term liabilities, but that doesn't really tell you how much of that mortgage they have to pay in this year. So what happens is companies will look at their long-term debt and they will do an entry at the beginning of the year in order to move over the amount of long-term debt they're going to pay in the year. And they move it over to an account called current maturities of long-term debt, so that people looking at the financial statements will know, oh, okay, they have, $10 million mortgage and they're going to be paying $900,000 of that mortgage in this year. So that impacts their financial health. It impacts how much of their assets are going to be spent on liabilities for the year. All right, I'm going to stop the recording there.